In the 1990s, if you were flying across the globe, there was one name that signaled pure luxury and reliability: Swissair. It was the national pride of Switzerland, so financially secure that it was affectionately nicknamed the Flying Bank. It held deep cash reserves and was a symbol of the country's economic might. For decades, Swissair operated with a strategy of high-end quality. They didn't compete on being the cheapest, they competed on being the best. Passengers paid a premium for the service, and investors trusted the brand as a safe harbor. But in the late 90s, the aviation industry began to shift. The European aviation market was deregulating. Low-cost carriers were emerging, and larger global alliances were forming. Swissair's leadership felt the pressure. They feared that if they didn't get bigger, they would simply be swallowed by competitors like Lufthansa or British Airways. In 1997, the airline launched the Hunter strategy. The goal was simple but incredibly risky: buy stakes in struggling smaller airlines across Europe and Africa to build a massive global network. They invested in companies like Sabena, LTU, and Waller. This was the turning point. Instead of focusing on their core business of high-quality service, Swissair transformed into a venture capital firm for dying airlines. They poured billions of francs into these struggling carriers, hoping to turn them around and dominate the market. The problem was that these smaller airlines were already bleeding money. Swissair wasn't just managing its own operations, it was effectively subsidizing the losses of half a dozen failing companies. The Flying Bank started to see its cash reserves evaporate at an alarming rate. By the year 2000, the strategy was clearly failing. The global economy was cooling down, and the aviation sector was facing headwinds. Yet, rather than pulling back, the board doubled down on their acquisitions, blinded by the sunk cost fallacy, the idea that they had already spent so much they had to finish what they started. Then, 11th September 2001 happened. The terrorist attacks in the United States brought global air travel to a virtual standstill. Insurance costs soared, passengers stayed home, and the entire industry plunged into crisis. For Swissair, this was the final blow. With no cash left and banks refusing to extend more credit, the company hit a wall. On 2nd October 2001, Swissair was forced to ground its entire fleet because it couldn't even pay for fuel or landing fees. Thousands of passengers were stranded globally. The sight of those planes sitting idle at Zurich airport sent shockwaves through Switzerland. It was a national trauma. The Flying Bank had officially gone bust, and the government had to step in with an emergency rescue package to prevent a total economic disaster. The company was eventually dismantled. Its assets were absorbed to create a new, smaller national airline, Swiss, which was eventually sold to Lufthansa. A brand that once stood for global dominance disappeared from the skies, leaving behind a cautionary tale of corporate hubris. The lesson here is one of focus versus expansion. Swissair succeeded when it prioritized its core strength, quality. It failed the moment it abandoned its identity to chase market share through acquisitions it couldn't afford. Growth for the sake of growth, without a foundation, is often just a fast track to insolvency.